Welcome, everyone, to Together We Serve TV show. It's Friday, August 30th. It's a Labor Day weekend. I'm excited because this Labor Day weekend, we're going to have a unique guest. My guest was the winner of Forbes 30 Under 30 Businessman of the Year. Very prestigious award, but he was 29 years old, and he's doing unique things in the mergers and acquisition space and the financial space. And I'm sure he's helping millennials and the people under 45 because money is such an issue right now because of mental health. We stress out about money. Our mental health gets worse. COVID's been here. Hopefully it's gone. But we need to handle our money and handle our stress with money, but also be able to handle the stress by doing great things like acquiring businesses or acquiring property or acquiring whatever it may be. My guest is going to talk all about that. And you know, the nice thing is he comes from a service mentality. He's here to serve. If it's not a fit, he won't bring you on as a client. He'll probably find you somewhere else to go. That's what a servant heart does, especially in the finance industry. He'll talk about more. It's cutthroat. It's tough. I can't think of the word, but mano a mano is probably the best word that comes to my mind. So let's bring on our guest, Matt Bodnar. Matt, welcome to the show.
Steve, thanks for having me. I'm glad to be here and glad to be live. I'm excited. It should be a lot of fun.
Why does Matt jump in at such a young age into finances and mergers and acquisitions?
I do want to clarify, just for the record, I'm a Forbes 30 Under 30 alumni, so I won it. I'm 37 at this point, so I probably got to take that out of my bio at some point. So, I'm pushing 40 now, but
you still won the award. That's the most important thing, which is great.
I did. I mean, it was like 2016 or something, or 2017. So it was a while ago. Steve, did we lose you? I don't know what happened to Steve.
Yeah, you're still good. You're just still good. You're in the speaker mode. I'm going to let you speak.
Oh, got it. I see how it goes. Okay, yeah. So it was. It was a while back. So I just wanted to clarify that. I'm no longer 29. I would like to be 29, but unfortunately not. But yeah. So my background's really simple. I worked at Goldman Sachs up in New York for a number of years out of college. Came back to Nashville, which is where I'm from, in 2011. And really started working on deals, bought a small IT business at the time, ran that for a number of years, did a few acquisitions over the course of operating that company, and then eventually kind of hired somebody else to run it and really focused on being a full-time investor. And so today I've built a portfolio of operating businesses ranging from IT to software to manufacturing to distribution, a couple other investments. And, I like to talk about buying businesses and doing deals. And I genuinely believe, Steve, that especially if you have an existing business, I really think mergers and acquisitions are one of the most powerful growth strategies. But even if you don't have an existing business, I also think there's a really compelling narrative that entrepreneurship through acquisition is a really powerful strategy for wealth building and creating value, and a really compelling alternative to, let's say, starting your own business.
Let's work in the 25-45 age range. They're thinking, oh, Matt, that's great, but I don't got a lot of money, or I can't do that. Dispel that myth. You've obviously done it. You were 29, you were doing it. You're doing it at 37, and you're still going. What could you tell them to keep them going to do, or give them the opportunity to do this?
Yeah, well, there's a couple different ways to think about it, right? And so if you want to get involved in broadly what I would call like the searcher ecosystem or the independent sponsor ecosystem, both of those are two big things that have really come to exist in the last 5 to 10 years that 10 or 15 years ago weren't things. I'd never heard of a searcher. I'd never heard of an independent sponsor, and you might not have heard of those either. But those are sort of cottage industries that have emerged over the last 5 or 10 years that are all about a slightly different economic model, but very similar approach. Basically, really smart people or motivated people who want to go and buy a business, especially as an alternative to starting a business. And the backdrop for this is also really important, which is the massive amount of baby boomers that are going to be retiring over the next 10 to 20 years, right? Depending on what kind of estimates you look at. I've seen estimates that there's $10 trillion of enterprise value that needs to change hands over the next 20 years or so as baby boomers retire, right? And again, there's different estimates out there, but depending on what numbers you look at, the average number of businesses sold annually in the United States today is somewhere around 30,000 businesses a year. The estimates I've seen are that the number needs to jump to about 400,000 businesses a year to accommodate all of the baby boomer owned businesses that need to change hands. And so if you think about just that backdrop alone, if you're interested in entrepreneurship and you want to go out and be a business owner, an incredible bounty of businesses out there that aren't going to have a home, aren't going to have a future, aren't going to have a trajectory. And a lot of those businesses are also really have a lot of low management standpoint. They're really under optimized. So there's opportunities to come in and add a lot of value as an operator. And oftentimes you don't have to be a strategy genius or have some crazy thesis about how you're going to improve the company. In a lot of cases, just basic digital marketing, tackling a lot of value. So that's the backdrop that makes it really interesting. Me excites me about the potential of buying businesses as a general entrepreneurship strategy.
Well, and you open the door for all entrepreneurs. If it's merger acquisition, there's a lot of opportunity out there. Just from what you said, just entrepreneur, whether they are acquiring stuff or not. Thank you for sharing that, because people are like, all these opportunities are gone. They're not, and they're changing every year, right?
Well, it's amazing. I mean, without getting too much into the weeds, one of the areas, for example, that's seen a tremendous amount of M&A activity in the last 5 years, 10 years has been HVAC businesses, right? Heating and air conditioning, plumbing, et cetera. Those businesses, home services broadly, have been super hot. Like, people are gobbling those businesses up left and right. I was talking to a friend of mine 2 days ago who owns a brokerage that's focused in the home services space. And he was telling me that there's 40,000 independently owned plumbing businesses in America.
Oh, he'll be right back. Oh, there he is.
Oh, there we go. Yeah, my camera is struggling. I don't know why. But he said
we can hear you clearly.
There's 40,000 independently owned plumbing businesses in America. There's 40,000 independently owned HVAC businesses. And so even though there's been huge consolidation in example, just those two sectors where people have been really aggressive and active buyers for a long time, there's still a huge amount of opportunity out there, which to me was really encouraging.
Now, what's interesting too is you open the door for people are like, well, I want to do something. I don't want to do my 8 to 5, but I don't want to acquire stuff. So you're saying there's more opportunities out there for the 25 to 45-year-olds to get out of the 8 to 5. Not saying there's anything wrong with that, because we need 8 to 5 workers, but the person that wants to be on their own, and not everybody should, right?
Yeah, I mean, I think if entrepreneurship is an interesting path and you're thinking about it, right? Entrepreneurship through acquisition, or ETA is the term that's come about in the last couple of years to describe that framework, that approach, has really that ecosystem has bloomed in the last 5 to 10 years. And it's really early days in terms of the amount of baby boomers that are retiring, in terms of the amount of capital that's really starting to understand that space. And so even if you don't, and we can talk about deal structures and strategies and creative financing and all of these elements that you can do, as you've eloquently put in the title, doing deals without loans or outside capital. But there's also a really robust investor ecosystem and lending ecosystem that's sprouted up and is increasingly expanding even to this day, that are really focused all around these lower middle market or small business acquisitions and supporting entrepreneurs who want to get into that world. So 10 years ago, it was Wild West. Nobody was really thinking about this. And now it's really become a very prominent economic model. A lot of folks are operating that world. A lot of investors want to invest in that asset class and are really interested in those kinds of deals. And so, and the SBA program is a tremendously supportive government program that basically subsidizes entrepreneurs who want to buy businesses, for lack of a better term. There's certainly risk associated with it, but really great kind of financing structure for people who are thinking about going out and doing a deal.
Yeah, I like the SBA I work with here in Northern California. I'm going to be talking to some businesses to do that. You're right. That's a great opportunity that anybody could try. The worst thing is you try to get a loan, you don't get it, then you find something else. That's the thing, is at least give it an effort. It doesn't cost you anything, right?
Yeah, exactly. Yeah. Well, yeah, if you don't transact, right? I mean, you might have some broken deal expenses depending on what you spend on legal and due diligence and that sort of thing. But the earlier on you are in the process, the less real risk you're incurring as a potential buyer, right? And a lot of folks, again, if you're thinking about, hey, I'm really interested in M&A or buying businesses, but I'm concerned about taking out a big SBA loan, or I don't know how to raise capital from investors. I don't, I'm worried about the risks associated with that. There's still a lot of avenues that you can pursue, that you can do deals even without those constraints, right? I mean, and if you think about this ecosystem of retiring baby boomers as a backdrop to that, right? One of the ways that you can potentially get equity ownership in businesses is with what I call seeds, which are sweat equity and earn in deals. And seeds can be a great way to help a business owner that is maybe nearing retirement age, doesn't really have a lot of, they haven't invested in marketing or modernizing their business in a lot of cases decades, right? I mean, we bought a business 3 years ago that didn't have a website. The entire business was operated on pen and paper, carbon copy sheets, totally non-digitized. Their entire marketing budget was a TV commercial from the 90s, right? And so, those kinds of businesses, that was an acquisition that we did, but there could have absolutely been opportunities for somebody who's young, who's hungry, who's excited. If you go to a baby boomer like that and create a framework where you can earn in 10, 20, 30% of that business over time and create a bunch of value for them. And by the way, if and when they want to retire, you're now in the whole position to be the person who buys them out, right? I mean, nobody's kids, it's ironic to say this, that we're in the middle of a social media live stream, but like nobody's kids wants to own a plumbing company. They want to be an influencer. Like seriously, right? I mean, they have zero desire to go and buy, their parents' company that manufactures metal fasteners, right? That nobody wants to do that. And so if you're interested in entrepreneurship, finding the person who owns that metal fastener company and their kids move to LA and they want to be TikTok influencers, and finding a way to work with them, earn some equity in their business, and eventually be the trusted hand that they turn it over to, is a tremendous opportunity, right? So those kind of sweat equity and earn-in deals are a great way for folks who, even if without taking the risks associated with an SBA loan or raising capital from investors, et cetera, you can pursue deals that don't need outside capital and investors and so forth.
It's powerful, and it's funny. They want to be a TikTok influencer, but they've got a 30-year-old company making millions. They don't want to step in. It's already set up. It's already churning money. You just need to step in and maybe bring in. It's an ATM machine for you. And I shouldn't say it like that because it's much more than that. But it's interesting at 37 that you're saying that, because you're right. Everybody, even 60, 70-year-olds want to be influencers. Like, look at that. I put a video up. I make millions.
Yep.
5% of the
people.
It's the
everybody
number.
wants to live that life.
So I learned from you, because you were on my podcast, which you were a great guest on my podcast, Warren Buffett. We're both big fans.
Huge fan.
So I want you to tell about Warren Buffett, what you saw from him, what you learned from him, how you influenced what you're doing today.
Yeah. And I think Warren Buffett, not really a huge surprise as an investor and somebody who focuses on mergers and acquisitions. Studying Warren Buffett, who's not only just the greatest investor of all time generally, but also happens to pretty much have a strategy that's focused largely around buying businesses, made a lot of sense, right? So it didn't take some huge breakthrough insight for me to realize, hey, I should probably study this guy who's the best in the world, ever, basically. And so I started reading a ton of Warren Buffett stuff, probably too much, right? It's like seeped into my brain and, shapes my thinking to this day. But so read a ton of all the Warren Buffett writings that are out there, all his shareholder letters, every biography, all the books, that kind of thing. And if you read enough Buffett, you also come across this guy named Charlie Munger, who is Warren Buffett's business partner and an incredible thinker, really fascinating businessman. He recently passed away, but really, really, both of them big intellectual influences on me, just in terms of how to think, how to operate, certainly how to buy businesses. But Buffett's strategy is really simple, right? And Berkshire Hathaway, his company strategy, is really simple, which is just buy great businesses and hold them for a really long time and focus on taking care of the stakeholders in that business, the management team, the customers, et cetera, and giving them the freedom to keep doing their thing. And in a lot of ways, that has shaped my approach. Again, I don't pretend in any way, shape, or form to be even 0.1% as good as Buffett, but my thinking has certainly been shaped meaningfully, and the deals we look at and the approach we have is really around that same idea of, hey, we want to be a long-term home for the businesses that we acquire. We want to invest in the people and the stakeholders and the folks who are part of those businesses. And we can talk about practically, mechanically, kind of what that looks like if you want to unpack that. But, we want to have a really long-term orientation for the deals that we look at. And, we're not looking to buy a business and slash and burn and resell it again in 3 years or 5 years or whatever. We're really looking to invest, make long-term decisions that make sense, and also put in place mechanisms so that when we win, the employees win, the companies win, the management wins, the stakeholders win. And that, before meeting you, Steve, I didn't really use the term servant's heart, but I think in a lot of ways that informs my approach to doing deals in business, right? I mean, it's at the end of the day, it's about trying to create a positive impact on people's lives, whether that's through, and again, without getting in a huge sort of philosophical debate, right? Whether that's through employing people and just being in business, and which I think is generally a social good, but also really specifically trying to, in the businesses we operate, be somebody that takes care of folks and makes, tries to be sort of operate on a positive footing and do the right thing and those kinds of things.
Because you said servant's heart. And I want to get back to that because it's missing in the finance. And as I said in the monologue, it's cutthroat business. And we've talked about that. But if you got to spend 20 minutes with Warren Buffett, what's the questions you would ask him?
I mean, honestly, it's, in a weird way, I've spent so much time consuming his content. I don't know that there's some magical question that I would ask him that would like blow apart my understanding of deals or the world or whatever. I probably could get a pretty good approximation for how he would think about most things. It may not be a fruitful question, but if I were to meet him and ask him, I'd probably ask him, hey, if you're me and this is sort of what I'm up to today and what my portfolio looks like and the deals I'm looking at, what would you do differently? Right? Or what would you change? Or if you woke up and we were, body swapped, which wouldn't be very fun because I'd be losing about 50 years. But if we body swapped and you're in my body with my existing portfolio, skill sets, relationships, what would you do from there? Right. And that's like a thought exercise that I think is kind of helpful generally with anyone who you consider a mentor or an intellectual influence is asking that question of, hey, if Warren Buffett woke up in my body tomorrow, like what would he do differently? Right? What would he change? What would he immediately stop doing? What would he immediately start doing? What would be some of the adjustments? And I think to hear that from the horse's mouth, I think would be really interesting.
Yeah, I love those. I knew you'd come up with a question. You went around, it was perfect. Great questions. Cause if he could help you, that's great. You mentioned service. Together We Serves the show. Servant's Heart's my podcast that you were on. How does somebody make sure they're getting served when they're mergers and acquisitions? Is it part of it hiring somebody like you, education, or is it just getting to know somebody?
I mean, I think it depends on what kind of stakeholder you are in the market, right? Are you a buyer? Are you a seller? Are you an advisor? Because depending on sort of where you sit, you're going to have a different need. You're going to have a different approach, et cetera, right? And I mean, candidly, Steve, I don't typically like work with folks as an advisor to help them do deals per se, right? I'm mostly focused on doing my own deals, but I obviously create a lot of content around buying businesses because for me, I think it's really synergistic with a lot of the stuff that I do in terms of generating deal flow and opportunities, generating maybe investor interest in deals that we're working on, generating even like employees and folks that want to come work for us or work for some of our portfolio businesses, and then also potentially driving revenue or positive outcomes for our various portfolio businesses. So that's at least sort of the MO of why I like to create lots of content around buying businesses and talking about it. But coming back to the question of I may be interpolating a little bit, but how do you really approach M&A broadly or buying businesses from a place of having a servant's heart, right? And to me, I think it manifests itself maybe in the ways that you act as a participant in the market, but I think it really starts with an internal orientation, right? And I'm certainly not perfect at this by any means, and probably on a daily basis screw this up and violate the norms or the terms that I would like to or the boundaries that I would like to live in myself. But I think it's about the quest to kind of pick yourself back up, try to do the right thing, constantly try to be sort of a positive influence on people. And the way that takes shape could be a million different things, right? Depending on what kind of interactions you're having with somebody, depending on what you're trying to solve for, depending on if you're buying or selling, et cetera. But I'll give you a couple illustrations that might shed some light on this. So when I think about management of existing businesses we've invested in, one of the big approaches, a term we talk about a lot, is we have a very collaborative approach to management as opposed to a command and control approach. And what that means is a management team, the folks running a business that we might invest in or acquire, we're not typically going in and slamming down on the table and do this and this and you need to do these things and so and so's fired and all this stuff. We really have an approach of, hey, we want to hear, what are you working on? What are the challenges? Where are the opportunities we can support? We want to collaborate. We want to be supportive. I think I don't really use the term, but like servant leadership type approach of, we want to empower them to be really successful. We want to bring the resources to the table that enable them to do that. And those might be connections, those might be people, those might be customers, those might be vendors, those might be that might be capital, whatever the resource configuration is that will help that business succeed. We try to bring those resources to the team and we say, hey, here's what's available, here's our perspective, but we also want to hear your view, right? We want to figure out how we can approach this from a perspective of taking care of everybody, right? And making the best decision for the business, ego aside, and sort of putting our ego down. So that's one example of how we would approach that from a management standpoint. I'm happy to give you some other illustrations, but that's at least one way of the companies that we operate, how we try to come from a place of collaboration versus a place of command and control, which I think at its root stems from a point of view oriented towards having a servant's heart.
Yeah, and your content you mentioned, I've got the YouTube channel going across there, and I'm going to show it at our halftime segment. One of your videos that you've done. You've got a lot of good content there, don't you? Talk about the YouTube channel, what you're doing with that.
Yeah, well, I think the YouTube channel is an offshoot of really my whole social media strategy, right? Which, for better or worse, is all around the various elements of buying businesses, right? That could be ranging from deal flow to evaluating deals, which I love to kind of talk about and unpack. And I have a newsletter that we kind of do these deep dives where I'll usually do like a 10-minute video for my newsletter subscribers on, hey, here's a deal. And I'll pick either deal I'm looking at or a deal that somebody will share with me, and I'll unpack it for better or worse, right? So we've seen some deals that were terrible and we've seen some deals that were super interesting. But I like to just go in real time. Hey, here's what I'm thinking about the valuation. Here's what I'm thinking about the margins. Here's what I'm thinking about the customers. Here's what I'm thinking about maybe a potential deal structure for this transaction. And I've historically just shared those with my newsletter subscribers, but we've started to put some of them out, some of the older ones out on YouTube too, to kind of give folks a sense of sort of what kind of content we have in there. But on YouTube, generally, it's just me talking about all the stuff that I do every day, which is looking at deals, finding deals, evaluating them, and the whole life cycle of M&A activity, right? Which also includes how to figure out what a company's worth. Valuation is a huge puzzle, right? A lot of existing business owners really wrestle with not knowing, what's my company worth, right? Which is a pretty major question to answer. And especially if one of my favorite anecdotes or pieces of common wisdom that you'll hear in the mergers and acquisitions world is, if you want to sell your business, the best time to start is 5 years before you want to sell it, right? If you want to sell your business and you're starting tomorrow or yesterday, you're way behind the 8 ball, because there's lots of stuff you can do operationally to improve the marketability, to improve the transferability of the value, to improve the exit potential for the company. And laying a lot of that groundwork, takes time, right? It's like planting a tree. And so folks who think about, hey, what's my company worth? I want to sell it in a couple of years. Well, if you want to sell in a couple of years, you should start right now figuring out what's it worth. What do comparable companies in your industry trade for? Who are the typical buyers? What kind of terms and structure are they putting together for a transaction? How do you think about valuation today? One of my favorite questions, I call it the 8-figure question, is basically any buyer of a business. I mean, if you're an existing business owner, you're probably getting emails from private equity firms that express interest in your company, right? I like to take a lot of those meetings just to sort of see who's playing in the space. And I like to ask them the 8-figure question, which is basically, hey, if you were going to, there's a couple iterations of this question, but if you were going to pay me 8 figures for this business or more, what would you need to see? right? And it's like, oh, they'll tell you because they want to buy it, right? Even if you're not there today, they'll say, hey, okay, here's what we need to see. We need to see customer concentration reduced from 30% of your top customer to less than 10%. We need to see recurring revenue go from 30% of revenue to over 60% of revenue. We need to see product level margins move from 40% to 45%, or what, I'm obviously making these criterion up, but they're going to tell you what they want to see. And another version of that question is, of the businesses that you've paid the highest multiples for or the most for in the last 12 to 24 months, what were the common characteristics of those businesses? Right? And you can get the playbook. It may not be easy to execute it, but you can get the playbook pretty easily for exactly what you need to do to your business to position it for a big exit. Now, that might be a lot of time, energy, effort, blood, sweat, and tears. It might be difficult to accomplish operationally, but you can get a really clear sense of what big buyers want and what they're looking for with a couple conversations with those buyers. And I think those are the kinds of conversations, if you want to sell, that you want to be having 2 or 3 years ago, not today, if you're trying to sell right now, right?
Well, the playbook reminds me, the NFL starting in 2 weeks. If the 49ers had the Rams playbook, it would be a huge advantage. And that's what you're saying.
Yep. Yeah.
Playbook for your company 3 years before, 5 years before. Build up to what your playbook looks like. Of course, it's going to change in 3 years, but you got an idea. You could be prepared and be ready to go, and then maximize your profit.
Yeah, and you can understand, hey, here's the 3 to 5 things or the 7 things or the 2 things or whatever that a big buyer cares about. Here's what they're going to pay for, and they don't care about this other stuff, right? So it's like you might be really focused on, hey, we're the best at XYZ, and a buyer's going to say, doesn't matter at all. And you might say, hey, this thing isn't really a huge priority for us. And a buyer might look at that and be like, hey, that's the whole ball game. And, we're going to pay you half of what we would have paid you if you'd made that a priority. Right. And those are very real things. I mean, there's tons of things that just pretty much disqualify businesses from potential buyers, depending on exactly what their buy box, just sort of the fancy term for what they want to buy and the specific criteria of an individual company look like. Depending on the buy box, like it varies by industry, but like there's just whole swaths of companies that are just not even considerations for 90% of private equity buyers because they don't check certain boxes, don't have enough recurring revenue, or they're not big enough, or don't have enough customer diversity, or whatever it might be. And you can get a really clear sense, and it's like, okay, well, if we have 2 or 3 years, let's focus our efforts on either diversifying our biggest customer or building more recurring revenue, making that a bigger focus, and going back to all of our clients and migrating them to retainers or whatever it is, right? Shifting the business model over time, because that business model is going to be worth more, right? And to take that out to an extreme, it also, like, industry obviously matters a lot, right? Certain industries, companies are more valuable than other industries. And, a classic example that I share a lot is like software versus construction, right? Sort of 2 polar opposites in a lot of ways, where software businesses are, very capital efficient, almost all or vast majority of revenue is highly recurring and contractual, can scale really quickly and have massive economies of scale, right? Because adding 1 new customer adds virtually no additional cost to the business. And they can, and as a result of those factors and others about software companies, they trade for revenue multiples, right? I mean, even pre the last 2 or 3 years, which valuations have softened a little bit, but they were trading for 10 times revenue, right? Now, if you contrast that with maybe like a small construction business, highly volatile earnings stream, highly project dependent, might be capital intensive depending on what kind of construction it's doing. And, it highly levered to what's going to happen to the economy, right? If there's a huge slowdown, people might just not do any construction projects for 18 months or 24 months. And then your entire business halts. It's terrifying for an investor. And as a result, those businesses trade for, 2 or 3 times EBITDA, right? Or even, depending on the size, maybe even less than that. And so not all industries are created equal, right? But the reason those industries aren't created equal is because they have certain business characteristics, i.e. things like recurring revenue, things like capital efficiency, things like margin scalability, right? Construction, I didn't hit on that, but like every job has materials and every job has labor, right? So you can scale, but you're not going to have a geometric scaling in your margins. Whereas software, every new customer, maybe have a tiny incremental hosting expense, but almost all of that margin drops straight to the bottom line, right? And so all of those economic characteristics are why those industries trade for higher multiples. But if you're engineering your business in advance to have some more characteristics like that, then you're setting yourself up for success.
I love it. Well, I'm going to give you a break. We're going to take a quick break, 5-minute break or so. Let him get some water because he's spitting out so much information, so much golden nuggets. We want to get a few more before we close the show. So we'll take a quick break and we'll see you in about 5 minutes.
It's Matt Bodner. I'm a private equity investor. I've done more than 100 million worth of deals. Former Goldman Sachs, former Forbes 30 under 30. Today, I've got Kevin Harrington, former shark from Shark Tank, on the show, and we talk all about building your dream team and scaling companies. With that, let's jump in. It's an awesome conversation. Kevin, welcome to the Science of Success.
Hey, Matt, great to be here. Thanks for having me.
Well, I think you have the honor of being the first shark from Shark Tank that we've had on the show.
I love that. You mean I beat Mr. Wonderful to the punch?
That's right.
He's a funny guy. I always joke. You know why he calls himself Mr. Wonderful? Because nobody else will.
That's a good one. I like that.
Yeah.
Well, that's awesome. Well, we're obviously super excited to have you on. You're a tremendously successful entrepreneur and have done so much and built so many different companies. One of the things that I'm earlier in my career than you are, and I think a lot about mentors and who are the mentors in my life. What does it take to find a mentor? How do you even define a mentor? I'm curious, in your journey in your career, have you had any mentors that were really impactful for you personally and helped you really shape your journey?
Great question. So I'll go back to the earlier days when I was an entrepreneur, and it's crazy. When I was in high school, my dad said, start a business. I started a business in driveway sealing in Cincinnati, Ohio. And then I started a heating and air conditioning company in college. And to earn income, I had to pay for my own college and room and board and car and insurance. And one day I'm watching TV and I was watching Discovery Channel and it went dark for 6 hours. And when I called the cable company to see what was wrong, they said, oh, Discovery's a new channel. It's just an 18-hour-a-day channel. They don't have a budget for 24 hours. So that's when I started putting products on Discovery Channel and cutting a deal with them. And all of a sudden, the world of infomercials and As Seen on TV was created and took off and boom, boom, boom. But in the beginning of all of that, I was a very headstrong entrepreneur. And so wanted to do it all myself, thought I knew everything. And we were having success and was a good salesman and all of that. But what happened is we were getting all these orders for products. We had the Jack LaLanne juicer, we had the Food Saver, we had Ginsu knives, Tony Little Fitness. I was having to finance all the inventory, and I was going to banks and I was going to investors and couldn't get money. And so I started thinking, well, what's the problem? I had a $50 million a year company making more than $5 million a year in profits. So we were, young and startup. So we were still spending money on first time cost things. So had a nice profitable business, young entrepreneur doing good, but nobody would touch me for money. And so I said to a few people, I said, I need some help. And I started reaching out. And one of my connectors, I believe that we all have potential mentors. And in the business I was in, I write checks to accountants, to lawyers, to phone services, to media companies. So I said, who do I write checks to? And I should be able to call them and ask for advice, right? Because I'm paying them, right? So, my lawyer said, you need to get a good fundraiser in there, maybe somebody that worked in a bank at a high level, and maybe a retired banker that could help you. So I was at a Chamber of Commerce meeting back in my hometown, and I'm out talking to people like, hey, I need to raise money. And so boom, here I am sitting in front of a retired bank president. And he looks at me, he says, I give him the story, and he said, so how much were you trying to raise? And I said, well, I've been to 5 banks. I've talked to dozens of other investors, can't get a dime.
Well, that's amazing. his show had Kevin Harrington. Did not know that till I did research. So Matt's kind of connected. But what's more importantly, he asked some good questions with Kevin, a guy that's done. He's been on Shark Tank, one of the first Shark Tank on his show, and he's in the beginnings of the show, I believe, but successful. And stuff that Matt talked about earlier that I want you all to remember is ask those questions like he was going to ask Warren Buffett. You get an opportunity to talk to somebody like that. What a great learning opportunity because they've done it. I think experience is the best teacher. I'm 63. I could probably help a few people with my experience. Matt's 37. He could still help some people. Doesn't matter your age, but it matters what you've lived, what you've done, and what you've accomplished. Let's bring Matt back. I've got a couple great questions for him. Matt, welcome back. Congratulations on getting Kevin Harrington. That's pretty awesome.
It was a cool conversation. Yeah, I mean, obviously he's accomplished a lot, and I've had the privilege of interviewing a number of business folks, roughly his caliber, and try to absorb as much knowledge as possible that I can, apply in my own life.
On a side note, it's the best advantage of having a podcast is you get
Huge
to learn
advantage.
right?
Yep.
Let's talk politics, but not like politics.
Interesting.
Politics in finance. What's going to happen? This is a year. Every time there's an election year, money is the talk, and it affects money. It affects interest rates. It affects loans. What's your thoughts on before the election, after election? What should people watch out for or look for?
Yeah, I mean, it's I'm certainly not an expert at forecasting economic events, so I do want to massively caveat this with that. My purview is much more highly specific to individual companies and how I think they're going to perform versus sort of a broad macro perspective. But I think generally, right, in any time there's uncertainty, capital sources are generally more conservative. And so in an election year, there's uncertainty, so capital is more conservative. I think the rate environment, there's obviously a lot of indicators that there's going to be easing on the rate side, which I think is sort of a positive economic indicator to a large extent, in terms of credit softening, cost of capital getting cheaper. But I mean, anecdotally, just in conversations I have with folks and stuff, it definitely seems like folks are somewhat conservative right now. I mean, I've done deals through a lot of different macro environments, sort of the pre-COVID world, the COVID insanity, trying to raise capital during COVID and do deals during COVID was pretty harrowing. I've done deals in the post-COVID. There was kind of a frenzy of deal-making activity for, from sort of late 2020 to early 2022. And then the rate environment really started ratcheting up and capital got a little more scarce. And so it's been like a couple lifetimes of seesaw in terms of deal climate in the last 5 years alone. And so it's changed a lot. But long story short, I think there's still, the economy fundamentally seems to be doing reasonably well. There's certainly pockets of pain. I pay really close attention to just, the news and sort of what's happening and how are bigger companies performing. And most of my exposure, I guess, to the market is really oriented more towards what I would call old economy stuff. So I'm less exposed to trends and big changes in things like AI and crypto and that sort of stuff. I'm really looking at, hey, are people buying more, hard goods and material products and that sort of stuff? That's typically where my exposure and my companies sort of interact. And so I think that, it's not negative, but I think it's cautious at the moment, just given a lot of the stuff going on in the market.
It's a great answer, and I didn't want you to get played on. You didn't, but I think the message that I'm hearing, I want the audience to hear from you, is things are going to happen, change, maybe a little faster. Just be prepared. Not like last year, or not like next year when there's no election. It just changes the environment a little bit, and be prepared, right?
Yep. Yeah, I think that's right. And I mean, for better or worse, my general approach is, if there's good opportunities and deals to be worked on, I think there's deals in every macro environment that makes sense. Sometimes it's just if the climate is more difficult and challenging, you just got to put in some more legwork to to get deals over the finish line, or to do deals, or to find deals, again, depending a little bit on the macro environment and what specifically is sort of impacting things. But, whether it's hard or whether it's easy, I think it's, I'm still out here working on transactions and trying to grow our portfolio companies and that kind of thing.
Well, I'm glad you said that too, because that's the other thing. Don't stop what you're doing. Don't be, keep moving forward. We have no control over it. But I love that you said that. Keep moving forward. And it doesn't matter if you're mergers or acquisitions, you're a plumbing company, you're a business coach. Just be aware. I think awareness is what you're saying. But keep doing business as usual. Is the phrase been around 100 years. Business as usual. Just be aware it's just a different year. I love that. I want to get into your business. I love your company name. I can't say it. And I know you laughed at it. Eidolon. There it is. I want him to say it to help me. Talk about Eidolon Capital, what you do, and what you're excited about with it. What's the future look like?
Yeah, so Eidolon, it's a pretty simple business model, and we've touched on a couple of the pieces of it already. Candidly, a lot of it's just inspired by Warren Buffett, right? And his approach with Berkshire Hathaway. But our thesis is really simple, right? It's find typically what I would call sort of more old economy, stable businesses, find great companies. Typically in our sort of strike zone is what we call lower middle market, which is normally sort of $2 to $5 million of EBITDA roughly. And often find ourselves looking at companies that are in manufacturing, distribution, business services, those sorts of sectors. And our thesis is pretty basic. It's find great companies, buy them, hold them for a long time horizon, and have a long-term orientation in terms of the decision-making that we approach the business with, which I think ultimately results in better decisions versus really short-termism or optimizing for quarterly earnings numbers or whatever, and take care of the stakeholders in those businesses over the long term as well, right? So if the management team and the key folks in the business and the employees are incentivized and win when the business wins, our thesis is basically that helps everybody move in the right direction. And so that's really the thesis at its core. We have a number of businesses in the portfolio. To date, we have a business that manufactures portable sinks. We have a business that distributes industrial shelving, material handling, pallet rack, that sort of stuff. We've got a business that does staffing for industrial facilities, warehouses, forklift drivers, that sort of thing. A couple other investments. I have an IT business and a software business. But really, our thesis is just we're old school, buy and hold, value-oriented investors, and we're not trying to reinvent the wheel. We're not trying to do the next AI, crazy tech unicorn. We're really just, our thesis is, hey, if we buy great businesses and we make good decisions or try to make good decisions, and certainly not all of our decisions are always right, but we try to make the best decision we can. That generally results in positive outcomes, right? And I don't know if I forget if we talked about this last time we chatted, Steve, but I'm a poker player. And so, I've played in the World Series of Poker a number of times and love to play poker. And one of the things you learn in poker is this concept of evaluating the decision quality and not the outcome. And that to me was a really instrumental lesson I learned early on in my life, just from playing cards, that has really helped shape my thinking about doing deals and investing and decision making broadly, which is poker is very rigorous in terms of evaluating decision quality. And you try to divorce that from the outcome. So it's like, hey, I want to make the best decisions I can based on the information I have. And in poker, you can get it all in pre-flop with pocket aces against somebody who has 7-2 offsuit. And if the flop comes 7-7-2, you're dead. You know what I mean? There's nothing you can do. So you should still do that 100 out of 100 times, right? And so it's just trying to make decisions that have a positive expected value, trying to make decisions that we feel like the preponderance of evidence supports being a reasonably good decision. And to borrow from Charlie Munger, trying to make decisions or trying to use, Munger's famous for talking about inverting, this concept of not only sort of evaluating your decision quality based on your assessment of it, but also looking at the inverse. It's like, hey, if I wanted to make a really bad decision, what would that look like, right? If I wanted to destroy this business, what would I do, right? I would do X, Y, and Z. Or if I wanted to destroy my health, right? And you can apply it to any concept, right? It's like, looking at the way to achieve a bad result, and then figuring out, okay, so if I wanted to destroy the business, I would do these 7 things. Let's pay attention to those things and make sure none of those 7 things happen, right? And so kind of informing your perspective that way. So that's our approach. That's our thesis. It's really not, we try to keep it relatively straightforward, and keep it simple. It's not necessarily easy, but we try not to have some view on the future of AI. We just want to have a view on, hey, are people going to keep buying, this core product? If we think they are for a long time, then we think there's probably demand for that.
Well, we didn't talk about poker because I love poker and I would have remembered. So I'm glad you mentioned that.
Nice. I didn't know you were a poker player.
WSOP would be my dream someday. And I'm actually playing on, practicing on a little tablet, and I watch the TV.
Love it.
And it's such, and I love that you said that, because it really teaches you decision making quickly.
It really does.
It really is a good education for business.
Yeah, I mean, it's funny because in business is to some extent the same way, but poker has really tight feedback loops, whereas business has really long and very murky feedback loops. But poker's feedback loop is great because you can really quickly evaluate whether you made the right decision or the wrong decision, even independent of the outcome, right? I mean, you can go run the math or do the analysis of the odds or solvers or whatever to sort of get a sense of, hey, did I make the right play here? And as long as you're making the right play, even if you end up losing that particular hand or that outcome doesn't play out that way, for me, I'll feel totally fine about losing a buy-in if I made the right decision. But even if I won a hand, if I made the wrong decision, I'm like, I'm beating myself up. So it's a hard discipline, but poker's pretty unforgiving. And if you don't apply the right lessons, you'll pretty quickly get smacked. And so I like that it's kind of a brutal game in that sense. Business, it to some extent is similar. Again, the feedback loops are longer, but you can learn some hard lessons in business too if you're not applying the right mental models.
Yeah, it's well said. I'm curious. So you own these companies that you mentioned, all these different very cool companies. Are you the outside looking in? There's management running. There's a day-to-day staff that runs it. You are just the investment arm of the company, and you kind of oversee it.
Yeah, we're investors. We're active board members. So we typically interact with the management team on a weekly basis, and oftentimes we'll develop basically like a scorecard of key KPIs, might be cash, receivables, some key sales metrics, key production metrics, those kinds of things. And we'll check in on a weekly basis. Hey, where are we on this and this and this? Any challenges, anything we can be supportive of, maybe some new information, whatever. But we try to be pretty hands-on, but we don't want to be in the way, if that makes sense. So we want to support, but we never want to be a bottleneck. We never want to be choking the business or, really sitting on the management and like making them, making their lives more difficult. We want to make their lives easier, and we want to clear blockages so that they can be successful. And, we're hands-on, but we want to be hands-on from a supportive standpoint, not from a micromanaging standpoint. And that comes back to that kind of collaboration versus command and control thing that I was mentioning earlier.
And that is a servant's heart board member or group of board members, is that we're not micromanaging is not a servant's heart.
Yep.
We're not allowing the experts to do what they do.
Exactly.
So I've heard, and you answered this question, your opinion, I've heard a great board usually makes a great company. A really bad board could take a company down. I know it's very hard to answer that, but is that somewhat true?
I think it can be on the extremes, right? If you have a board that this is an easy example, but if you have a board member who introduces you to a customer that doubles the size of the business, then yeah, that board's added a lot of value, right? Conversely, if you have a board member who somehow embroils the company in some sort of economic struggle or scandal or whatever, then sure, it could take the company down. But candidly, I think management has a lot more to do with board than to do with the company's performance than the board. The board is responsible for that in the sense that the board, in theory, selects the management, and the management is responsible to the board for the company's performance. And so at the end of the day, yeah, the buck stops with the board. There's no question about that. But the actual result creation, I think it's mostly the management team. Again, if the management team isn't performing and the board doesn't do anything about that, then that's on the board. And so, they can ultimately kind of drive those results by identifying the right managers, identifying the right metrics, kind of empowering them, giving them the resources to succeed, or replacing them if they don't. But to me, I was actually looking at Bain did this study. It was 2 or 3 years ago at this point, but I was reading back through it the other day, and they had this survey of private equity owners and basically asked, what were the factors that were the most impactful on your best exits, your most successful exits? And then they had the same questions: what were the factors that were the most successful, or the biggest headaches on your worst deals? And they asked a bunch of private equity firms this. You could probably guess the number one driver of performance for the best deals was the management team and the quality of the management team. And the number one reason why deals failed or underperformed was the management team or the quality of the management team. So I think management is probably more important than the board, but certainly the board can have a positive or negative impact. And ultimately, the board's, in theory, responsible for the management team.
Yeah. So your overseers, your third party, another set of eyes looking at things. They come to you and go, hey, we're seeing this. Marketing, what do you guys think? They don't have to do it, but they take your advice and move on with it.
Yeah, exactly. Yeah, and we'll say, hey, I want to present them with opportunities, but I seldom want to be force feeding an opportunity to them and saying, you have to do this thing, right?
Yeah. Well, you're the first guy in finance and in money that made time fly. Because usually these are boring subjects. I can't believe her.
I guess I appreciate that.
That's awesome, because for me, it's not, because I love them. I know people sometimes it can get very too esoteric, as the word comes to my head. But we're right in the end here, basically what I'm saying, and time flew
Fair
by.
enough.
I've got a fun question for you. I probably know the answer. So I just reserved the Learjet for you. There's 4 seats. You're flying with it. So there's 3 seats empty. Who are you going to invite, dead or alive, to sit in that airplane? And where are you going to fly to?
So I feel like you asked me this on our podcast, and I gave some absurd answer that was like, and maybe I do a similar answer that was like Jesus, Genghis Khan, and like Charlie Munger or something to that effect, I think was my previous answer. But I'll try to mix it up to some extent to provide a fresh perspective. Who am I putting in the Learjet? I still think probably somebody like Jesus, just one of the most impactful historical figures of all time, independent of whether you're a Christian or not, but also like his teachings and so forth. So I would say he would be on the plane. Since we talked about him a bunch, we'll throw Buffett on there, but that's kind of a freebie. And then let's do something interesting with the third one. I'm trying to think who would be good. I feel like after the last interview, I was like, no, I should have totally done so-and-so. All right, here we go. We'll do John D. Rockefeller. Arguably inflation-adjusted wealthiest person of all time. Maybe we can learn some stuff from him.
Amen. Where are you flying? Where are we going?
Oh, where are we going? We're going to Las Vegas for a poker tournament.
Can you give me another seat? Let's go to a 5-seater.
Yeah, you're hopping on the plane too, Steve. We'll pick
Let's
you up.
do it. Thank you again, Matt. Real quick, how can people find you?
Just anywhere on mattbodner.com is kind of my home base. I have a free newsletter for folks who want to learn more about buying businesses and how to do deals. And, it's just at mattbodner.com/newsletter or mattbodner.com. You can find it basically right on the homepage. So that's the easiest place to find me. I'm on pretty much every social network as well, and post content on a daily basis.
Thank you, Matt. This has been a fantastic show. I appreciate your time.
Awesome. Thank you so much, Steve. I appreciate you having me on here and having me back and having me live. So thank you so much.
It was awesome. Thank you. We'll see you all next week, 2 p.m. Pacific, 5 p.m. Eastern. By the way, if you're watching live, have a happy Labor Day, and we'll see you next week.